Hello, everyone, and welcome to Meet the Visionaries podcast, hosted by MIT Center for Real Estate. My name is Jainil Shah, and I'm a first-year student here at MIT in the Masters of Science in Real Estate Development program. I'm excited to bring to you conversations with leaders who are shaping the future of real estate. Today's guest is someone whose perspective I've admired for a long time, and I'm excited to share this conversation with you. Today, we are joined by Sally Ann Flood, US real estate sector leader at Deloitte. Sally Ann is one of the most trusted voices interpreting the forces shaping commercial real estate today. Over her nearly 3-decade career at Deloitte, she has advised leading developers, REITs, and institutional investors on everything from capital formation and M&A to audit and governance through multiple market cycles. Her perspective is grounded in both numbers and nuance, helping clients navigate transformation while balancing risk, opportunity, and purpose. She also serves on the board of SPUR, the San Francisco Bay Area Planning and Urban Research Association, and NCREIF, the National Council of Real Estate Investment Fiduciaries, and her firm is a recognized voice in ESG reporting and sustainable investment. What makes Sally Ann's outlook distinctive is her ability to connect macroeconomic data with real-world decision-making, translating insights into strategy. Sally Ann, welcome to the podcast.
Thank you so much for having me.
So let me start with the big picture, the pulse of the market as we head into 2026. Your 2026 outlook opens with the phrase, recovery paused but not stopped. Walk me through that thesis. And what signals give you conviction that there is a pause and not a prolonged downturn?
Well, this year's survey results really helped us paint the picture for our industry for 26, and we highlighted that pause metaphor on purpose. Our survey sentiment index pulled back slightly from 65 from 70 in the prior year, but it's well above 44, which was our 23 metric. So overall, our views for 26, they're still very positive across areas that include revenue growth, spending expectations, CRE fundamental expectations. What I liked was seeing that 83% of our respondents think that their organization's revenues will increase, and 70% were planning to increase spend for 26. I particularly liked that they were going to focus on areas like data and technology.
Well, thank you for that. Yeah. Building on that sense of temporary pause, when you survey hundreds of executives across asset classes, what themes or sentiments stand out most this year? Are people adapting strategy or just waiting for clarity?
Well, starting off, our respondents still see commercial real estate overwhelmingly as a haven asset class. It was nice to see that 75% of the respondents expect to increase their property allocations for the coming year, with the primary benefit cited as hedging against inflation and increasing diversification with other types of portfolio assets. So while there are definitely some waiting for clarity, as you'd expect, and that's driven by the capital market concerns, a couple were listed, like availability, elevated rates, cost of capital, were all listed as our top macro concerns. But indications from some U.S. market points shows kind of jumping back in, which I'm happy to see. So property sales activity was up again in Q3. Annualized returns are outperforming parts of the broader public markets, and private real estate returns have swung positive again. And so I think for those that are still waiting for clarity, I think the risk exists that they're going to miss that early mover advantage.
That leads nicely into something you speak often about, and that's judgment under uncertainty. You often emphasize judgment under uncertainty. How do you personally cultivate that skill, and how do you coach your teams to think clearly when the data itself is ambiguous?
Given that my background and my training was formed as an audit partner, so having that in mind, I do speak a lot about moving away from being an observer in moments of uncertainty to being an active participant.
Wow.
And this is facilitated with having a strong team and providing their perspective and bringing different angles from all parts of a business. The strong leaders I've worked with avoid short-term reactions, and they really act decisively based on medium to long-term convictions as part of their overall strategy. Some of that takes confidence, in particular when endeavoring on a strategy that could be game-changing. But looking for those opportunities and having the vision and the right team around you brings a strategy to life. And when I think of the great CEOs and entrepreneurs that I've worked with, they look for these moments of uncertainty and they truly strike while the iron is hot.
Wow. No, that's absolutely. It's they say there's always opportunity when everyone's looking to defend. It's the right time to attack. So absolutely. Yeah. And so, looking across the last 2 decades, you have worked with clients through multiple cycles, from the 2008 financial crisis to more recently COVID, and most recently the interest rate reset. What leadership traits separate firms that emerge stronger from those that stall during these transitions?
Yes, I have been in San Francisco for over 27 years, so I have seen multiple cycles, and I have seen that a strong firm culture outlasts these cycles. I've worked with some of my clients for over 25 years. They've seen a lot, but their leadership has stayed true to their corporate values. Strong leaders, they're looking at their leadership teams, succession plans, they're being prepared to alter course when needed, they develop strong governance models with board of directors and audit committees who are well qualified to play important fiduciary roles for investors. But for some aspects of real estate, you have to play the long game. And in these cycles, they are challenging times for many, and you have to buckle down and just look for the next opportunity, stay true to your culture, and stay true to your strategy.
Wow, that's such a powerful thing you mentioned, is having clarity and purpose and sticking strong with your culture, really defining what's expected of people, what the company stands for, and then just making sure your team aligns. Let's switch gears and dive into your research, exploring some of the deeper signals beneath the noise. Your research captures a paradox: optimism around long-term fundamentals, but day-to-day caution in capital deployment. How do you reconcile that?
Well, I think the next chapter of commercial real estate is going to be for the pragmatic realists. Some of the headline risks like macro volatility, policy whiplash, higher for longer rates, they're all very real, which means cautious, selective deployment in the near term. But also real are the openings for 26 and the next 12 to 18 months, repriced, better structured loans, cautiously reawakening of the lender pool, alongside deep private credit. Also selective strength in digital infrastructure, logistics, office. So I think there's a lot of opportunities there.
And, diving deeper onto the capital side, the report shows capital availability remains the top concern, even above interest rates. Is it about true scarcity of funds or capital waiting for clearer risk-adjusted returns?
A great question, because it's probably a combination of the two. I would index more on the former, like new lender counts, while rebounding sharply since the beginning of the year. They're still well below pre-pandemic levels, and there's still a wide need for financing, especially in office refinancings and some industrial. Like only 1 in 5 of our survey respondents planned to pay off their loans in full for the coming 12 to 18 months. And think about that. But someone's going to need to fill that void, or our industry maturity wall will continue to accumulate.
That's really interesting. 1 in 5 is definitely, is that something unheard of? Is that what would you say is the reason that people are so uncertain about paying off their debt?
I wouldn't view it as uncertain. I think that's more their plan. So when you have a difference in your valuations and your assets are well below the debt that you have in your books, that is their plan, that potentially they're not going to pay off and they potentially will hand back the keys. So I think it's more reality.
Wow. That's really interesting to see. It's actually strategic and not circumstantial. Yeah, thank you. So private credit and alternative lenders have expanded dramatically. From your conversations, is this a temporary bridge until banks return, or the start of a permanent capital realignment in commercial real estate?
Yeah, we're measuring that alternative lenders now comprise nearly 25% of all new originations, almost double the historic average.
Wow.
And so I think they are absolutely here to stay. A reminder, though, is that private credit, it's not really a new product. The larger scale players have made it more mainstream. They fill that void that was left by the traditional lenders. While some of us think traditional lenders are returning, we think borrowers have just grown more familiar with the alternative sources and have built long-standing relationships that are likely to persist. So from our survey, actually private debt was one of the top responses when we asked what sources of capital that they're likely to work with in the next 12 to 18 months.
That's great. I would now like to explore how deals themselves are getting done today. You have written about a shift from consolidation to collaboration, with fewer M&A plays and more joint ventures. What is driving the structural pivot? Is it risk management, capital efficiency, or strategic flexibility?
There's several factors participating here, and those reasons are really driven by organization size, which we listed out. So almost 24% of the larger organizations with assets under management above 15 billion, they're looking to gain access to property types that require more specialized knowledge. And that was the primary motivation for considering joint ventures or the partnership agreements. But when you look at the smaller organizations with AUM less than 5 billion, they're looking for partners to access new markets. So I think it's really a mixture of access, scalability, and expertise sharing.
Understood. And would it be fair to say that these joint ventures are then more strategics and less to do with, sharing the risk?
It just again depends on the asset size of again the size of the organization. I liked the area of just looking for expertise, sharing that expertise, because going into a market, for example, going into a market like data centers, if you don't have that expertise, you're absolutely going to need a joint venture arrangement to be successful there.
Absolutely. You flagged one-stop capital solutions as an emerging theme, with firms that can self-fund across the capital stack or align with long-term capital partners. How is this changing competitive dynamics?
We see this playing out more prevalently at the moment in the housing sector as public and private organizations aim to tackle affordability challenges, with some recent deregulation and reform initiatives aimed at cutting construction costs and boosting supply, promoting higher density development, like for the local municipalities. Those are encouraging, and more specialized, localized private participation help finance those affordable housing projects.
That's great. Looking ahead to the next 12 to 18 months, when you synthesize feedback from over 850 executives, what is the consensus view on timing? Are we looking at stabilization in 2026, recovery in 2026, or something even more uneven?
From the survey last year, when like 12 to 18 months ago, we anticipated this year would be the turning point. I was so optimistic for the industry's recovery and the pandemic era pullbacks. Now you can see, as we wrote in our 26 outlook, we're talking about today, it really did played out. Our respondents reacted. They largely said that the change was unpredictable, the environment is unpredictable, we have ever-shifting global macroeconomic environments. And so all of this contributed to an increased uncertainty. I think that impacted our expectations for the current outlook. And to some degree, the industry, we have to see how it's going to enter this next phase of the real estate cycle. Like our survey responses tell us we have likely turned the corner. I do feel that on some of the most challenging years, and we're moving towards growth again. There may just be more of a pause in the recovery today, as we highlighted, as organizations, governments, and our industry find more certainty from some of the headline risks, but not for good. So I think the pause is the right image that I feel reflects the current moment.
Yep. No, that I think the report really captures that well. That while it's definitely recovery from what we saw during the COVID years, it's still a little paused. Absolutely. Policy uncertainty ranked amongst the top three risks in your survey. What policy variables matter most for commercial real estate fundamentals right now, and how are investors underwriting around them?
Well, the changes in tax policy resurfaced as one of the respondents' top 5 concerns again. This is for the second consecutive year. For anyone working in real estate, tax policy is always going to be critical. We estimate that this remained elevated at the time of our survey, mainly for one specific tax proposal that was called Section 899. Now, while this ultimately did not get enacted when legislation was signed into law on July 4th, at the time of the survey, if this had passed, it would have increased rates on foreign investment into the US significantly. And so there was uncertainty about that. There was also uncertainty about the future of the Pillar 2 regime. That could also have been a factor. Lower in the results was a new entry this year to the responses, international trade policy. That ranked 9th globally, but was the 5th largest concern for our Asia Pacific respondents. And so while international trade headlines have likely been a factor behind economic uncertainty, the CRE leaders from the survey are really less concerned with its potential impact to their financial conditions for 26. And that might be in part due to global owners and investors coming to expect a more volatile trade environment after these initial discussions. As well as some regions and asset classes across the globe are relatively sheltered from the international trade risk due to shifts in structural trends like European multifamily properties or the Japanese healthcare sector.
So that's again really interesting that in times when most industries are very uncertain, something as significant as commercial real estate and even other forms of real estate are seeing, steadiness. So that's definitely
Yes.
That's very interesting to learn.
I'd agree.
Yep. Before we wrap, 3 quick takeaways for listeners navigating 2026 and beyond. What should they be watching, doing, and reframing right now?
Well, you're asking for 3, but we had 15. I'll only highlight a few here. The first was the early mover advantage. That may be coming to an end. I think CRE leaders should stay tuned to a potentially improving capital market climate, be ready to act with conviction, and before the rest of the market's ready to come back to the table. Second would be reset investment strategies and underwriting assumptions. CRE leaders should recalibrate how they evaluate their deals, properties, their debt strategies, factor in the higher financing, exit cap rates, and underwriting, and determine if selling and repurposing projects may be wiser than holding. And then third, they should also carefully be evaluating where it makes sense to ally with strategic partners to help expand market share, capabilities, access to new markets or property types, and weigh out those options, whether it's M&A, joint ventures, other partnership, P3 arrangements, and review interest rate expectations and keep an eye on the central bank stances.
Sally Ann, thank you for bringing your clarity and perspective to the show. For those who want to dive deeper into Deloitte's 2026 real estate outlook or your broader thought leadership, where should they go?
I think follow any of my fellow leaders on LinkedIn, but also look at our Deloitte Insights. If you go to Deloitte.com, Deloitte Insights, there you're going to see a whole slew of our data, financial services research center produces some phenomenal publications. We just issued our investment management article just in the last week. For our CRE outlook, you can look at the commercial real estate button. You can also search directly for Deloitte US Real Estate. That will bring you to our landing page, and then you'll see all of our articles and thought leadership, whereas we'll have our outlook there, but also some other hot topics that we have looked at that include AI, tokenization, M&A, housing, and a lot more. And we'll continue to publish those as they come.
No, thank you so much, Sally. And I think this was immensely beneficial to all of our listeners, to me for sure. Just want to thank you again for your time for this opportunity. And this was Jainil Shah from MIT in conversation with Sally Ann Flood, US real estate sector leader at Deloitte. Thank you again.
Thank you very much for having me.
Thanks to our listeners for tuning into another edition of Meet the Visionaries podcast. And please remember to stay tuned for future episodes by subscribing to our podcast or follow us on social media by visiting cre.mit.edu to learn more. Until next time, take care, listeners.